Welcome, everybody. Thank you for taking some time today to join us on our accounting and auditing update. As Rachel indicated, I'm a partner and team leader in Withum's healthcare niche and have over 25 years experience providing audit, tax, and advisory services, primarily to healthcare and nonprofit organizations. I've worked with many of you, or at least those that registered over the years, and I've met many others who are on today's webinar at various different HFMA and other healthcare industry meetings and events. Joining me today is my colleague, Ryan Miller. Ryan's a manager in a firm, and he's also a key member of our healthcare niche. Our goal today is kind of simple, to provide you with some recent developments in the accounting and auditing area, provide you with some updates that you could take back to your accounting and finance teams. But before we get started, I thought a little bit about Withum would be helpful. Withum, for those of you that don't know, is at its firm, both the firm and the healthcare niche have continued to grow in recent years. We're currently around the 25th largest CPA firm in the country, plus or minus one. We were founded in New Jersey over 45 years ago, but now we have offices not only in New Jersey, but New York, Boston, Philadelphia, Washington, D.C., Orlando, and most recently out on the West Coast in Irvine, California. Ryan and I both recognize that an hour-long webinar is going to pass by very quickly. So as you can see from the agenda, we've set a very limited agenda. Ryan's going to walk you through and provide an overall GAAP update. If you've been in the finance department for a while, you've noted, or you will note during the course of this webinar, that it's been a relatively slow year for new accounting and auditing standards, particularly with respect to those anticipated to have a significant impact on healthcare organizations. That said, we have identified a few topics that we think will be relevant to the group, and we plan on highlighting them in about a minute. About halfway through the webinar, Ryan's going to pass the baton back to me, and I'm going to spend some time covering COVID-19 and some of the accounting and financial implications that the CARES Act is having on our financial statements. In recent weeks and months, the AICPA and others have been providing a fair amount of guidance, whether it be provider relief funds, advanced or accelerated payments from Medicare, public assistance programs, PPP loans, and the like. And I'm going to do my best to provide an overview of some of the key accounting matters for you. We're going to continue to watch the clock, but time permitting, we'll wrap up our hour with some general comments on the current workplace environment and recent trends and tips that you may want to consider as many of you continue to adapt to the remote working environment. With all that said, it's my pleasure to turn over the webinar to Ryan Miller.
Thanks, Michael. My pleasure to be here with all of you, and thanks for taking an hour out of your day and spend with us on our healthcare GAAP and accounting and audit update. I'll start with GAAP accounting and audit update topics, and to lead it off, we are going to be starting with leases. We wanted to start with one of the most applicable updates that have come out. We thought leases for private entities, a lot of companies haven't adopted the standard yet, and for public companies, they have adopted the standards. We're going to highlight on that. We're going to go over our lessons learned from the revenue recognition standards, the revenue recognition standard adoption. We'll then lead in with the not-for-profit reporting of gifts in kind project from the FASB, and I will close it out with recent accounting standard updates. These are all issued in 2020, and just going to briefly go over all of them with you, so you're all aware of what came out in 2020. And we'll start with leases. So Accounting Standard Codification 842, leases. We'll go over the effective dates and overview with you. Significant changes, criteria for a finance and operating lease, financial statement presentation and disclosures, and impact to the healthcare industry. So we'll start with the effective dates and overview. So for public entities, it begins with fiscal years beginning after December 15th, 2018. This standard is applicable to. For non-public entities, it's for fiscal years beginning after December 15th, 2021. This deadline was extended due to the recent COVID-19 outbreak and gave non-public entities some more time to adopt the standard. Transition entities have the option to not recast prior periods, so you won't have to restate your prior period financial statements. A key consideration, under the new standard, there are two balance sheet classifications, a finance and an operating lease. And essentially this accounting standard update removes operating leases that extend over 1 year, and it removes them from the footnotes of the financial statement and puts them onto the balance sheet as capital leases, and makes the accounting for it a little clearer. Instead of having a footnote disclosing your future operating, the footnote will still be in there disclosing your future operating lease commitments over the next 5 years and thereafter, but that will also be accounted for on the balance sheet, which will provide additional clarity. On the next slide, significant changes under the new standard. So the lessee recognizes an asset and a liability on all leases, including operating leases with a term greater than 1 year. If the term is less than 1 year, it will be expensed. The asset description is the right of use asset. And operating leases with a term of less than 1 year to be expensed, as I said before, that's consistent with the former lease standard. The lessee should factor into the measurement of the asset and liability the likelihood of exercising the option to continue or not terminate the lease, and any optional payments to purchase the assets at the end of the lease term. Next slide. So the criteria for finance lease classification. First, ownership of the underlying asset is transferred to the lessee at the end of the lease. So you have to make sure that these criteria are all met. And the second one, the lessee has the option to purchase underlying asset at lease end and is reasonably certain to exercise the option. The lease term represents the majority of the underlying assets' estimated remaining useful life, and the present value of lease payments equals or exceeds substantially all the fair value of the underlying asset. If the lease does not meet one of the criteria above, it is classified as an operating lease. Next slide. Here we'll go over the financial statement presentation. On the balance sheet, finance and operating lease right of use assets will be presented separately from each other and from other assets. Also, finance and operating lease liabilities will be presented separately from each other and from other liabilities. Now on the income statement, finance leases, interest expense on the lease liabilities and amortization of the right to use assets are not required to be presented as separate line items and shall be presented in a manner consistent with how the entity presents interest expense and amortization of similar assets. For operating leases, you must include lease expense within operating expenses, consistent with historical presentation. Next slide. So here are the required financial statement disclosures with the adoption of the new lease standard. Generally, you have to describe the description of the entity's leases. You'll need to disclose the basis and terms and conditions on which the variable leases are determined. The terms of the lease extension or termination. The terms or residual value guarantees provided by the lessee. Restrictions or covenants imposed by the leases. The finance lease cost segregated between the amortization of the right of use assets and interest on the lease liabilities. The operating lease costs for the period. The short-term lease cost, excluding expenses relating to leases with a lease term for 1 month or less, and information regarding the significant assumptions and judgments made in applying the requirements of ASC 842. So how did this standard impact the healthcare industry? Well, by the numbers, leased assets may account for a significant percentage of total assets and total liabilities under the new standard. Your balance sheet is going to change after this adoption if you deem to be material. Obviously, there could be other impacts, financial statement covenant impacts that you would need to consider as a result of this adoption. In the healthcare industry, leased assets largely include buildings and improvements and clinical equipment. They'll all have to be analyzed for the new adoption of the standard. Now, in the accounting department, evaluating, measuring, and recording of the leases will have to be done. The initial evaluation that we found can be both complex and time-consuming. Through our experience with some clients that have adopted this, we have found that it is complex and time-consuming and can definitely assist you. For financial reporting, you must consider the potential impact on the financial covenants after adopting this codification. Like I said before, your balance sheet and your income statement could significantly change, which could throw your financial reporting and covenants. It could change them, and you could be in compliance with a covenant 1 year, and just because of the adoption of this standard, you could not be in compliance with your covenants, and it would be, and you could usually just get a waiver and you communicate with the bank these things. And these could have a significant strain on your resources. Like I mentioned before, you should consider whether your entity can implement a system to evaluate each lease contract. You may want to consider outsourcing this function if it's practical. So with that, I'll go to our first polling question.
Here is the first poll, true or false. Under the new lease standard, ASC 842, operating leases with a term of less than 1 year are to be expensed. All right, how about 20 more seconds to submit your answer? All right, 10 seconds. All right, I'm going to close it out, and here are the results.
Great. Everyone mostly answered it correctly. Less than 1 year term, you expense it. Awesome. Now we will go through the lessons that we learned with helping our clients adopt the new revenue recognition standard. So effective January 1st, 2019, private companies are required to comply with Accounting Standard Update ASU number 2014-09, revenue from contracts with customers. The new standard results in a 5-step process to follow when recording revenue. First step in the process listed here is that you must identify the contract. The second is identify separate performance obligations. The third is to determine the transaction price. The fourth, allocate the transaction price to performance obligation. And fifth, recognize revenue as or when each performance obligation is satisfied. Next slide. So through our experience, we found that many clients found that certain revenue streams or contract they thought would be relatively easy to analyze have taken more time to analyze than they thought. Below are a few initial lessons that we learned summarized. So like I mentioned before, gathering the data took more time for a lot of the clients than they had anticipated. We assisted as needed, or they sought outside help to adopt this and gather the data. The process of gathering the appropriate information to adopt the standard took significantly longer than expected for some clients. You'd have to have they would need a deeper understanding of revenue contracts or performance obligations could be identified, and you can properly adopt the standard. We also found that contracts spread over time require new thinking. Companies are required to recognize revenue over the life of the contract, and contracts that expand over time may require additional analysis. Companies may also now have to budget for revenue differently because of this. Next slide. We also found that costs associated with obtaining the contracts are important in adopting the new revenue recognition standard. So a company may incur incremental costs to obtain a contract. If the costs are expected to be recovered, they should be recovered as an asset and amortized over the life of the contract if greater than 1 year. Companies are identifying assets for payments to consultants and other vendors associated with obtaining the revenue contract, for example, and analyzing these costs must be done in addition to recognizing the revenue properly. Next slide. So here we are going to go through a recent update the FASB just passed, and it was for not-for-profit reporting of gifts in kind project. So for not-for-profit entities, this is applicable if they receive gifts in kind donations. Gifts in kind are donations of tangible and intangible personal property and contributions of services made to a nonprofit. Amendments will be effective for not-for-profit annual reporting periods beginning after June 15th, 2021. The primary issues surrounding transparency and evaluation of the gifts in kind are relevant because not-for-profit entities may rely on the gifts in kind to fulfill their missions and run their programs, which could be more important information to users and something that may not be clear in current financial reporting. Also, the value of the gifts in kind can impact key metrics for not-for-profit entities, such as program expense ratio and liquidity reserve ratios. Next slide. So the FASB is considering for the not-for-profit reporting of gifts in kind, they're considering requiring a not-for-profit to disclose the amount of contributed non-financial assets disaggregated by category. They're also considering requiring a not-for-profit to disclose its policy for monetizing rather than utilizing contributed non-financial assets. The not-for-profit does not need to disclose its intent for the use of the contributed non-financial assets. And the not-for-profit also should disclose a description of any donor restrictions that are imposed. Next slide. So the FASB is also considering requiring a not-for-profit to provide a description of the valuation techniques and inputs used to arrive at a fair value measure for contributed non-financial assets, and also requiring a not-for-profit to disclose the principal market used to arrive at the fair value measurement if it is a market in which the recipient not-for-profit is prohibited by donor restrictions from selling or using the contributed non-financial asset. Next slide. This brings us to our second polling question.
So our second polling question: how many steps are in the process when recording revenue to comply with ASU number 2014-09, revenue from contracts with customers? 2, 3, 4, or 5? About 20 more seconds. All right, 5 more seconds, get in your votes. Okay, and I'll close it out, and here are the results.
Great. It seems like most of us got the answer correct. The correct answer is 5. And that is on the first slide of that piece of the presentation, if you want to go back. That brings us to, this is a summary straight from the FASB of the recent accounting standards updates that were issued during 2020. We'll go through them and list them just at a very high level here in this presentation. However, if any of you have any questions, follow-up questions, or would like to discuss any of these, or they might be applicable to you or your organization, we'd be happy to help you with them. Please give us a call. The most recent, so I started with the most recent update, which was 2020-06. And it was debt with conversion and other options and derivatives and hedging. And this update provided clarity for the accounting for convertible instruments and contracts in an entity's own equity. Now, this can be very complex, and if any of you have any questions or if this is applicable to your organization, have any problems with this, please don't hesitate to reach out to us. Update 2020-05 is revenue from contracts with customers and leases, the effective dates for certain entities. So we went through this earlier, or I went through this earlier in the presentation. They did update the effective dates for certain entities due to the coronavirus pandemic. Update 2020-04, reference rate of reform. Facilitation of the effects of reference rate reform on financial reporting. Update 2020-03, codification improvements to the financial instruments. Next slide. Update 2020-02. Update for financial instruments, credit losses and leases. And update 2020-01, investments, equity securities, investments, equity method and joint ventures and derivatives and hedging, clarifying the interactions between the topics. So here I'll pass it over to Michael, and he will go over healthcare industry, COVID-19, and CARES Act implications with you.
Thanks, Ryan. And actually, before we jump into that, Ryan just listed out 5 or 6 different standards, maybe not necessarily applicable to many in the healthcare industry, but maybe applicable with respect to some of your smaller for-profit entities and the like. In addition, we have a number of people on today's webinar that have either implemented the new revenue recognition standard 606 or are in the process of implementing 606, and some of them have actually deferred that yet another year until 2021. Similarly, we have people on the webinar today that have already implemented the new leasing standards, and many on the webinar today that will not implement the new leasing standards for a couple of years. So there's a little bit of a broad, we tried to do some broad brush presentations with respect to the A&A update, but as you have specific questions relative to your organizations, please reach out to us. I'm going to cover the healthcare industry, COVID-19, and some of the CARES Act implications, and we have on the next slide. As many of you know, the CARES Act attempted to alleviate some of the financial strain, whether it be on hospitals, physicians, or other healthcare entities, through policies that temporarily boosted payments and allowed for flexibility in the treatment of modalities, also expanded the availability of advanced or accelerated payments from Medicare. You may recall, you may have been involved back in April, the CARES Act established a provider relief fund to support healthcare entities with healthcare related expenses or lost revenues attributable to COVID. Most of our clients have seen significant reductions in revenue, not all, but many of our clients, I should say, have seen significant reductions in healthcare revenue and also the incremental costs. So from an accounting perspective, we thought we would start with the provider relief funds. And on the next slide, we get into some of the specifics, but the initial distributions with respect to some of these provider relief funds really began about 5 months ago. Many of you, if not you, some of your colleagues were required to agree to various terms and conditions prior to receiving some of these provider relief funds. I'm not going to go through all the details, but among other things, your organizations have likely agreed that the funds were there to reimburse only for healthcare related expenses or lost revenues attributable to COVID. The funds may only be used to prepare for, or respond to COVID. Non-compliance with the terms and conditions that you may have agreed to is grounds for recoupment of some or all of the payments. And the recipient will not use the funds to reimburse expenses or losses that have been reimbursed from other sources. And we're going to touch on that a bit more later on in the presentation. But again, there was a laundry list of terms and conditions that were agreed to. These are some of the highlights from our perspective. HHS has indicated that recipients will be required to submit documentation demonstrating that the payments were used for healthcare related expenses or lost revenue. They haven't gotten into too much specifics yet as far as we know. And they've also stated that they're going to perform a significant amount of anti-fraud and auditing work relative to these funds. So that's why I think there's a heightened sensitivity. Many of the organizations signed the terms and conditions, received the funding back in April and May, and are now waiting, or PPP funds back in that time frame, and now are anticipating applying for forgiveness, whether it be with respect to PPP. How do we handle the accounting for some of the funds that we receive? And equally important, what are we going to have to provide in terms of documentation? And that, as we sit here today, there's still a fair amount of uncertainty that exists with regard to what documentation will need to be submitted and in what format it's going to have to be submitted. There's a number of constituents out there that are providing input, and I anticipate that some of the documentation that's going to need to be presented is going to mirror what we're seeing from the SBA and financial institutions with respect to PPP loan forgiveness and some of the other stimulus funds. But suffice to say that recipients must be able to demonstrate that the total payments from the provider relief funds do not exceed their lost revenues and the increased expenses attributable to COVID-19. And equally important, that they have not been reimbursed from other sources. No double dipping, if you will. On the next slide. From an accounting perspective, the relief funds are treated a bit differently if you are a not-for-profit organization versus a for-profit organization. If you're a nonprofit entity, you should generally account for them as non-exchange transactions in accordance with the contributions received section of the FASB codification. That model, to the extent that you're not familiar with it, requires that an entity first determine whether the non-exchange transaction, or the contribution, if you will, is conditional or unconditional, and we'll touch on that in a minute. And if it is conditional, the recognition of the contribution revenue would be deferred until those conditions are substantially met. So on the next slide, you'll see, because entitlement of the payments is in fact conditional on having incurred healthcare related expenses or lost revenues, and because any non-compliance with the terms and conditions that either you or your colleagues may have agreed to would be grounds for recoupment by HHS, or some, as a result, some of the payments could be considered conditional contributions, and thus contribution revenue would be recognized only to the extent that the healthcare related expenses or lost revenues have been incurred at that date. On the next slide, from a for-profit perspective, the accounting would really be similar to non-exchange transactions, to other non-exchange transactions, and generally recorded as a government grant. And as you see in the middle of the page, the grants would generally be recognized in income when there's reasonable assurance that the recipient will A, comply with the conditions associated with the grant. I think everybody believes that they are in fact complying, and B, will receive the grant. And at this point, you've already received it, so the uncertainty associated with that has already passed. On the next slide. Once there's a reasonable assurance that the conditions will be met, the earnings are recorded on a systematic basis over the period in which the entity anticipates recognizing the costs or expenses associated with which the grants were intended to compensate. So as a result, the grant income would be recognized only to the extent that the entity is reasonably assured that the healthcare related expenses or lost revenues attributable to COVID will not be reimbursed from other sources as of the reporting date. If the amount of the payments received exceed the amount of the grant, that difference essentially is reported as a refundable advance. That is a liability as of a particular point in time. And if your entity has material grants, you should also consider disclosing the accounting policy for such grants and its impact on your financial statements within the notes to your financial statements. Next. Polling question 3.
Yep, under our third polling question. Under the CARES Act, not-for-profit entities should account for general distribution payments as non-exchange transactions in accordance with ASC 958-606, income, allowance for bad debt, and fixed assets. All right, 20 more seconds. All right, 10 seconds. I'm gonna close it out. And here are the results.
Good. Almost 3/4 of you have the right answer, non-exchange transactions in accordance with ASC 958-605. You know, generally when I was in high school and grade school, the answer with the most words was generally the correct answer, and that happened to be the case here. Well, joking aside, as we kind of move forward with the presentation a little bit, as you might expect, you know, there's a lot of uncertainty out there regarding the recognition of whether it be the contribution or the grant income at any particular point in time. And this is probably a more significant analysis for those of you on the webinar today that have organizations with a fiscal year end in June or September as compared to a calendar year. The first thing that you must be able to do is demonstrate that the total payments from the provider relief funds do not exceed the lost revenues and the increased healthcare related expenses associated with COVID. So that's the first half of that big bullet there. And even if you do that, healthcare entities who seem to believe that they have a large cushion between their reimbursable healthcare related expenses or lost revenues and the payments received from them, any payments from other sources, for example, if you receive some FEMA funding or other provisions within the CARES Act, they need to be considered when making this assessment as of a particular reporting date. So again, you know, you've received funding in many instances from multiple different payers or sources. You're counting up your expenses, and we're going to talk about tracking of the expenses a little bit later on. But you need to make sure that you're not double dipping and that in fact you are able to demonstrate that the payments received do not in fact receive the reduction in revenue or the incremental costs associated with COVID-19. On the next slide. So as you may know, certainly a portion of the provider relief fund was established to pay for the treatment of uninsured COVID-19 payments. This program is administered by HRSA. Healthcare entities, you know, are paid for the services at Medicare program rates. Generally speaking, the participation rules are similar to the Medicare fee-for-service program, with healthcare entities agreeing to accept the program payment as payment in full. There's no balance billing with respect to these programs. As a result, according to HRSA, the payments received are claim reimbursements, and they should really be treated in the same manner as reimbursements received from any other commercial insurance company, Medicare, Medicaid. Essentially, the federal government is acting as a third-party payer here, and the payments would be considered, as I said, patient service revenue. In light of the fact that there's no balance billing requirement, differences between the gross service revenue and the amount that's ultimately paid under the program would be considered a contractual allowance rather than a change in estimate or an implicit price concession under 606. So a little bit of details on what happens with the uninsured payments that are received. On the next slide, many of your organizations have also received, Medicare accelerated and advanced payments. Generally, organizations will reflect those advances as a contract liability. The liability would be reduced over time as claims are submitted for the services provided after the recoupment period begins. So there is an assessment that needs to be made with this process. However, one of the key things that you need to think about is if the entity does not expect to have sufficient Medicare volume to be able to settle the liability or the advanced funding that it received, it may be appropriate to reclassify some of the amounts that will need to be repaid to CMS from a contract liability to a refund liability, but essentially recording a liability and then drawing down on that liability as claim reimbursements are submitted. On the next slide, just a little bit on some of the temporary increases in payments. As I indicated earlier, the CARES Act really attempted to alleviate some of the financial strain on healthcare entities. There's a whole new series of policies to temporarily boost payments and allow for added flexibility. For example, many of you are aware that the CARES Act increased the Medicare inpatient payment rate, or it delayed the 2% sequester that you're accustomed to. Again, if a healthcare entity has adopted 606, which many on this webinar, your organizations already have, then such changes will affect its estimates of variable consideration when determining the transaction price. Alternatively, if you have not yet adopted 606, again, I think these will be included in your estimated, your determination of your estimated net patient service revenue or any receivables that may exist at the end of a particular reporting period. Next slide just deals with some other programs, specifically FEMA. As you know, FEMA provides assistance in responding to major disasters and emergencies. Many healthcare entities, particularly the large healthcare systems, are going to be eligible for reimbursement of extraordinary costs associated with the operating room, associated with operating emergency rooms or providing of temporary facilities. Here in the New Jersey area, particularly in northern New Jersey, that was really the epicenter when COVID first hit. There were a number of temporary facilities that were developed to handle the potential surge that we were going to have on our healthcare system. There's costs associated with that, and FEMA is going to be providing assistance. Many of our clients are in the process of or have recently applied for FEMA funding. And what's going to become important is on the back end that, again, to the extent that you receive funding through other sources of the CARES Act, and you also receive funding through FEMA or other programs, to make sure that as an organization you're not double dipping. That's probably the largest concern from this point forward from a fraud and abuse and an accounting and certification perspective. Down on the bottom of the page, similar to other funds, any FEMA funds would be accounted for as non-exchange transactions in accordance with the contributions received subsection of the FASB guidance. So, not much different than what we covered a little bit earlier. We're doing pretty well on time. I have about 4 or 5 slides here dealing with the Paycheck Protection Program. I'm not going to go through them in great deal, but I do want to highlight a few things. We're going to focus less on the program itself because you've been learning about and dealing with the Paycheck Protection Program for 5 or 6 months now. Our focus is really going to be on the pending repayment and or forgiveness of the loans. But before we do that, I thought it would be important to highlight some of the more significant risks related to the PPP funding. And these risks really aren't much different than some of the other funding that your organizations may have received. But certainly from a risk perspective, you need to ensure that the appropriate documentation is being maintained for PPP loan forgiveness. Many of our clients are inquiring now as to when that PPP forgiveness application should take place. Many of the financial institutions, quite frankly, are not yet ready to accept applications. Others are ramping up. We anticipate with the extension of the 8-week covered period to the 24-week covered period that those covered periods are going to be ending soon. Also with the loosening of the restrictions and the dollar amount that needs to be spent on payroll versus non-payroll, That coupled with the 24-week extension, many of our clients, and I suspect many on the call, your organizations, are fulfilling or at least incurring expenditures from a payroll perspective alone that will allow for full forgiveness. And everything that I've read and heard is that's really the intention here. The federal government wanted to stimulate the economy, wanted to provide cash flow to small businesses throughout the country, particularly those in the healthcare industry. And now that the forgiveness process is going to take place, we're hearing rumblings that that forgiveness or that process may not be quite as difficult, and the loans, or I'm sorry, the auditing of the documentation may not be quite as strenuous as what we had originally thought. But the biggest risk, as I've alluded to on a couple of occasions now, is that second bullet point there, ensuring that the entity is not double dipping against any other programs. And that's where the documentation issue is going to become so significant to your organizations. You're going to need to be prepared to defend the certification that you needed the funds. And that's what's going to, in my judgment, come under increasing scrutiny from the SBA as we move forward. There's already been a significant number of articles written about organizations that applied for and received PPP program loans that may not have been eligible for them, or received funding from numerous different sources. And there's a gray area, if you will, as to quantifying how much of those funds were used for which particular program, and again, making sure that we're not double dipping, or your organizations are not. On the next slide, with respect to the PPP loan repayment, or more importantly, the forgiveness, hopefully for many of yours, the forgiveness application will be filed with your financial institution. Once it's filed, the lender is going to have 60 days from receipt of the completed application to issue its decision to the SBA, and the SBA is then going to have 90 days to render a decision to its lender. So, based on that timeline, we sit here today in the middle of February. Most on this call probably have not applied yet for forgiveness with their financial institution. Once they do, it could be up to 2 months before the financial institution makes a recommendation or issues a decision to SBA, and then another 3 months for the SBA to issue a final decision back to the lender. So, that 5-month time frame in many cases is actually going to push the forgiveness into calendar year 2021. That being said, you do not need to wait until the end of your 24-week covered period to apply for the forgiveness. And as soon as your financial institution is ready to accept that, you may want to consider that process sooner rather than later, especially if you're interested in getting the forgiveness recorded prior to the end of the year, just because based on that 60-day and 90-day window that both your institution and the SBA have to render their decisions, it may wind up straddling the calendar year. The decision is pretty simple. They're either going to approve it. Now, that approval could be in whole or in part, or they're going to deny it. And no payments of any principal, interest, or fees are due until the date that the SBA issues its decision to the lender and or remits the loan forgiveness amount. If the borrower, for one reason or another, does not apply for loan forgiveness, and we certainly hope that's not going to be the case with any of our clients or anybody on this call, then the deferral period would end 10 months after the end of its covered period. And if for some reason the forgiveness is denied, and again, we think this is going to be a decreasingly smaller number as we move forward, then the deferral period would end to the extent that the repayment is due. The next few slides deal with documentation requirements, and many of you have been living in the PPP loan world for a number of months now. I'm not going to go through this in great detail. This is more a reference, if you will, a future reference for you. This is continuing to change. Every time I listen in or speak to an expert in this area, they indicate to me that the rules continue to change, that the financial institutions and the SBA don't have the wherewithal to do the comprehensive audits that we thought were once going to be needed. However, we thought it was important to keep these slides in here because there is some uncertainty, as I indicated earlier, as to what's going to be required for some of the other provider relief funds or FEMA funding. And we think, quite honestly, that they're going to mirror to a certain extent, at least on the expenditure side, some of the requirements that have been indicated or at least initially offered up by the SBA. So from a payroll perspective, be prepared to have bank account statements or third-party payroll reports available. You're going to want to have your tax forms readily available. They may have to be submitted, quarterly payroll tax, both federal and state, to the extent that you have canceled checks out there or other statements documenting any contributions to employer health insurance or retirement plans that were included in the forgiveness amount. That information is going to be required. Again, many organizations, and I'll pause here only because many organizations, with the extension of the 8-week covered period to 24 weeks, have sufficient expenditures just on the payroll side alone. So I think these 3 bullet points are probably in many instances the vast or the overwhelming majority, if you will, of what will need to be provided in order to apply for forgiveness. There's also an FTE calculation that's going to be necessary, the average number of FTEs per month during the reference period. So you're going to have to be able to document that for both the financial institution and the SBA to the extent that they ask for it. On the next slide, we have some information relative to non-payroll costs. We see this as a declining percentage of the overall forgiveness, just because as you flip through this slide and the next slide, you're going to see that it's going to require yet additional documentation. And if you could satisfy the full forgiveness by simply providing the payroll records and the documentation associated, payroll tax returns and the like, why would you then want to get involved with mortgage interest payments and providing copies of amortization schedules and canceled checks, verifying that the eligible payments during the covered period were made, or why would you want to get involved with providing copies of your current lease agreements and again canceled checks about rental payments that may have been made, or copies of any utility invoices? You have to send copies of invoices from February of 2020 as well as those paid during the covered period. Again, canceled checks, receipts, account statements, all verifying that those payments were made and that they're in fact eligible for forgiveness. So as you can see, the documentation starts to grow if you're providing amortization statements and lease agreements and copies of invoices and the like, to the extent, at least my personal opinion, to the extent that you could get full forgiveness by simply providing the payroll information, that may be an easier way to go as you move forward and apply for forgiveness in the tail end of 2020 or early part of 2021. Last slide on documentation, just to wrap up. This is information that you need to maintain, but it's not required to be submitted to your lender. So, you should have a copy of your PPP Schedule A worksheet, documentation with respect to some of the salary and wage data. I'm not going to go through this in great detail, but certainly documentation with your that's submitted with your loan application, the certifications, and most importantly, you need to retain this documentation in your files for a period of 6 years after the date the loan is forgiven or the repaid in full. So again, just some thoughts on what you need to maintain. This information does not need to be submitted to anybody, but certainly you're going to need to maintain it for 6 years in addition to all the information relative to payroll and non-payroll costs as you apply for forgiveness. Next slide. And we're going to pull this together pretty quickly. We only have about 8 or 9 minutes left in the presentation. There's been a lot of discussion recently about will a single audit be required for any of the funding that I received. And as you can see, the SBA has indicated or issued guidance that PPP loans will not be subject to single audit requirements of Title II. So that's good news. The first sentence there is very good. To the extent that you received a PPP loan, it would not be subject to single audit requirements. However, the second sentence there indicates that some of the other similar funding that may have been received, for example, the economic injury disaster loans, they were received directly from SBA as opposed to coming from your lender. And as a result, they do qualify as federal assistance, and they will be subject to the OMB Uniform Guidance Single Audit requirements for nonprofit entities. So again, many on the call have received PPP funding. Fewer on the call probably have received some of the EIDL funding, but to the extent that you did receive EIDL funding, that would be subject to the uniform guidance and a single audit. In addition, The Department of Health and Human Services in July did provide a definitive answer indicating that the audit requirements for the provider relief funds will in fact be subject to single audit. So as indicated in that last paragraph there, to the extent that you as an organization expended more than $750,000 worth of funds during a fiscal year, those funds will be subject to audit in accordance with uniform guidance. And then it gets into some details, and this is still being ferreted out a little bit, but it gets into some details as to whether there'll be a program-specific audit or whether it'll be an audit on the entire financial statements as a whole. And as anybody that has undergone a single audit in the past, there are additional reports. There's internal control and compliance reports, as well as additional schedules that will need to be included in your financial statements. In many cases, for 1 year only for many organizations, and many of the participants on this webinar are going to be dealing with single audits for the first time in some of their professional careers. Next slide.
Okay, we're on to our fourth polling question. For-profit entities that expend blank or more of provider relief funds during their fiscal year will be subject to an OMB audit. 100,000, 500,000, 750,000, or $1 million. All right, about 20 more seconds. Okay, I'm going to go ahead and close it out. And here are the results.
So 68% came up with the right answer, $750,000. So, you know, either you've been through single audits in the past and you're familiar with that threshold, or in fact, you were paying attention as we were going through some of the slides. So either way, the vast majority of you, it is $750,000. We are running short on time here. We have 5 minutes. I'm going to be very, very quick. Ryan and I are auditors. We have many clients on this call. You know, what are our auditors going to be doing is a common question or thought. You know, from my perspective, we're going to be looking at this in varying degrees. It's all based on materiality. It's going to be dependent on the dollar amount that you receive, the funding, the different sources, the terms and conditions associated with that. Generally, you know, we're going to want to, like anything else, we're going to want to make sure that the funds were properly accounted for. We're going to want to see documentation to the extent that the funds, if it's a loan, a PPP loan, that it's been properly forgiven. We're also likely to perform more extensive audit procedures if it's recorded as a government grant, only because we need to, you know, take a look at the revenue recognition aspect of it there and make sure that the expenditures have been incurred, the lost revenues or the increased expenditures have been incurred that would warrant recognition. So we touched on that a little bit earlier. And then finally, I'm going to conclude by the next slide, just how do we go about tracking our expenses and double dipping? And I've heard, you know, one more slide, Rachel. You know, some organizations have actually set up, you know, separate bank accounts, if you will, to keep the funds separate. However, at a minimum, we think that organizations need to establish some form of tracking mechanism regarding the flow of funds. It could be as simple as an Excel spreadsheet, and it needs to detail out what those funds are that were received and the qualifying expenses for which they were used for, you know, and then as we indicated earlier, you know, maintaining the backup for each of the qualifying expenses, whether it be third-party payroll reports, tax filings, internal records, invoices, receipts, bank statements, et cetera, et cetera. So most important, before I turn it back to Ryan to wrap up, was you know, that if you as an organization have received funds under multiple programs, you need to have some type of tracking mechanism in place for each of your funding sources to make sure that you're not double dipping, if you will. That's probably the biggest risk as we sit here today, move forward. And I think that's where the focus is going to be on the federal government as they audit these programs and forgiveness awards in the future. And with that, I'll turn it back to Ryan so he can wrap up in the last 2 minutes or so.
Thanks, Michael. So we wanted to end with some remote workplace considerations, recognizing that most of a lot of the work being done is being done remotely, how it affects internal controls at your organization, or how auditors are going to be performing their audits in the future if site visit limitations are imposed. This slide basically summarizes that a lot of companies and CFOs are going to be going more to a remote workplace. As a caution, companies should be evaluating their current processes and controls to be sure that they are reflective of the change to working remotely. Auditors will be testing that and reviewing that those controls are remaining effective if they change due to the remote working environment. Next slide. The downsides of the remote workplace we listed here for obvious reasons. You can't have teams in place like in the past, and these were just some tips that we put together for you. Next slide. So in remote auditing, we're going to have to, as auditors, overcome some site visit limitations from the pandemic, and we just wanted to let you know that it's all possible. We were able to use technology to do video walkthroughs and interviews with everyone, and mostly everything that we've been able to do in person in the past, we're able to do in the same capacity virtually with our clients through the use of our auditing technology that we have. And we just wanted to make that clear. Next slide. And just a couple summarization slides for you about changes going forward due to the remote workplace that CPAs, auditors are going to be are doing in the future. You can go to the next slide, Rachel. These are site visits, site visit limitations, like I mentioned earlier. Next slide. And remote auditing, walkthroughs, physical inventory counts, and fixed asset testing. Remote considerations for the future. And we will conclude with that. So thank you, everyone, for attending our webcast. And if you have any questions, please don't hesitate to contact Michael or I in the future, and we'd be happy to help you with anything we've gone over.